Hi, Warren William here from Smartest Data, with the key factors driving the US stock markets for the week starting December 12th, 2022. Undoubtedly, the CPI number tomorrow, 13th of December, and the Fed funds rate announcement on Wednesday, the 14th, are the key focus. Consumer optimism continues to rise as fears of inflation ease and wage growth remains surprisingly strong. Regarding the earnings report this week, stock investors will be looking towards Pfizer. So let's look at the major indexes, the possible sector rotations as we start a new phase in the market with a focus on tech, and a stock idea to close. So let's go to the video. Undoubted in 2022, the key economic factor impacting the US stock markets has been inflation. Inflation peaked a couple of months ago at 9.1% and is now on the way down. Consumer sentiment continues to rise, building on the recent trend with the preliminary data from the University of Michigan Index of Consumer Sentiment rising to 59.1 in December from 56.8 in November. On Friday, the US producer price report was worse than expected and the major indexes fell on the news. November PPI went up 0.3% month on month in November and 7.4% year on year, keenly watched by the financial markets. Okay, the forecast for inflation is key. The November CPI report and the Fed funds meeting on Wednesday are the key most important economic events remaining in 2022. Both of these events could set the tone for the beginning of the new year. The Fed will likely remain a hawkish stance even if a mild CPI reading is announced. Any reading below 7.5% would likely be viewed as positive for the stock markets. It is unlikely that CPI will return to sub 2% in the foreseeable future. The period of 2% inflation is not returning as the period of cheap goods, energy and labour is over. The FOMC is expected to announce a 50 basis point rise on Wednesday. The key question on everyone's mind is what will be the peak for the Fed funds rate during this tightening cycle. Current indications are around about 5%, thus indicating more rate rises to come, and at this point the first signs of a dovish pivot by the FOMC will likely be towards mid-2023. Retail sales have been strong this year, and later this week will be the November retail sales, which is a key measure of consumer spending. Retail sales are expected to have dropped by 0.1% in November after rising by 1.3% in October, which was the biggest monthly increase since February. Okay, enough for economics, over to stocks. There was a negative week in the US equity markets last week, with continuing concerns over the FOMC raising interest rates and the PPI data announced on Friday. The Dow Jones lost 2.8% for the week, which was its worst week since September. The S&P 500 fell by 3.4% and the Nasdaq by 4%. Stocks are fighting against the current equity market risk premium, which probably sits in the order of 170 basis points, give or take. This is way below the level seen during boom times, which was at 300 to 400 basis points. Any reading below 200 basis points is not considered an adequate return over and above bonds, the risk-free, for the investment in equities to be justified. Also understand that a typical bear market lasts for around 200 to 300 days, which puts us into mid-Q1 2023, which could actually coincide with a possible tail end of the current tightening cycle. Also, there is the triple impact which could assist some companies. High inflation leading to some pricing power, higher interest rate leading to some deleveraging, recession which gives companies the possibility to restructure. Okay, so let's move on to sectors and sector rotation, and in particular tech. For the S&P 500 to move ahead out of this bear market phase, keep in mind the sector weightings. Even after a difficult year, tech's weighting is still more than 25% of the S&P 500, while the expected laggards going forward, energy and utilities combined, are around about 8% of the total market cap. For sure, tech stocks over-earned over the past couple of years. Earnings have been downgraded, but towards the end of January, earnings guidance will be key. Tech stocks are restructuring, they're cutting labour. In general, they have strong balance sheets, so higher interest rates are not critical. The issue going forward will be their earnings. Their earnings power is not what it was a couple in the past, when they clearly over-earned. Nevertheless, returns of 10 to 15% are feasible. So let's go to Netflix and the bar charts to take a look at the 3-month graphs for the Bollinger Bands, MACD and RSI. So last week, the Netflix management gave a positive, optimistic outlook and the shares went up. Other stocks that also responded were Paramount Global, Warner Brothers and Discovery, and Walt Disney. As we move out of this bear period, the sector rotation, the two laggards are likely to be energy and retail. Last week, the stocks in the energy sector like Chevron, SLB and Devron all had a negative week as oil prices continued to be flat. Retail, Costco missed earnings estimates on Thursday after the bell, which is not like them. Walmart, Target, Macy's and Nike also saw their stock prices go down. In Q3, Target and Walmart reported that sales were actually down. So let's move to a quick stock idea. So in this video next week, I will cover financials, in particular banks. So I'm looking for some financial stocks that could participate in an early cycle move. Here's one idea that came out from John from Bar Chart, Tiptree, TIPT. Some of the fundamental factors about the stock: the market cap is 522 million, so it's a small cap stock. The current PE is 9.3 times. Tiptree is an insurance and mortgage company which John found using bar chart screening functions to find stocks with the highest technical buy signals, highest weighted alpha, and also the best current momentum looking at the moving averages. Tiptree sells and manages specialty insurance products, mostly in the US. The business is split into two parts: insurance and mortgages. It offers niche commercial and personal lines of insurance, credit insurance, and collateral protection products. In closing, I use Bar Chart. I think it's a fantastic system. It's at a level of institutional investors. I'm a member of Bar Chart's affiliate program, and the link is below in the video. If you decide to subscribe to Bar Chart, use the link. That will greatly help the channel. Also, please like and subscribe the videos, and also keep watching the quick definitions videos to build your financial knowledge. Okay, so that's all for this week. There'll be other videos coming out later this week, but see you in this style of video the week ahead next week.